Yeah, guys, thanks again for joining on Sunday morning. As we maintain our tradition back to the usual timing every uh, every month, the first Sunday at 11 a.m. Uh, So let me just kind of brief of like what I've been doing in the last 1 month. Once we discussed, we met on I think 10th of June after the election. Broadly, what has happened is markets have been on a very good uptrend. We have also been on the road, meeting a lot of companies, connecting with. I was also in Mumbai for I think 7 8 days, and then I was traveling to Pune and a couple of other cities, Bangalore, etc. Now I'm back in Chennai. We are finishing up the research. As you have seen, we have already given you some of the profit bookings that we have done. We are working on fresh ideas as well. I know many of you could be, kind of because the cash has been accumulated, and some of you have messaged us as well that you have surplus cash to be invested in. All I would say is timing, especially the entry price, as I always said, matters a lot. It is very, very critical for us to invest at any the good stocks at the right entry point. See, even if I'll show in the future slides also that being invested is one very important critical aspect, but another critical aspect is investing at the right time, because otherwise what happens is if the market direction may kind of become turbulent, or there is a situation where there is kind of expectations that there can be some short-term shocks or something can happen for the overall economy. Those situations we will be better protected if our entry point is good. Typically, what we have seen over the last 10 years is that if we get the right entry price, many a times, even in the worst case, like when the COVID crash happened, or in 2022 when there was continuous 2 months of correction, our stocks never went below 25% roughly of the our entry price. So that way, what we call as a portfolio drawdown. So that drawdown is kind of protected. See, a very important aspect of investing is not just the potential that you can make, but also minimizing the risk that you're taking up, minimizing the drawdown, the loss that you can incur. In fact, that is our motto of SafeGainz: minimizing risk and maximizing returns. So first we talk about risk, that when you enter at the right price, your risk is minimized, and then we look at how can we maximize returns. By maximizing returns, as you would have also seen recently, we try to keep evaluating stocks on a regular basis, come up with, okay, because when we buy initially, there is a particular price target that we have in mind, but some new developments are happening, or overall at the government level or at the industry level, there are some very strong tailwinds. Because of that, we keep revising our targets upward. So these kind of things keep happening, and we try to take maximum advantage of it by delaying our profit booking or our exit from the stock, and that is how we try to maximize the returns. So as I was saying yesterday, I mentioned in the channel as well. I think two very important topics that I wanted to cover was asset allocation and why staying invested in equity is very important. And the second aspect is, I know some of you have got questions on defense stocks and why we have not been very aggressive with defense bets. So I thought, let me take the opportunity in the monthly connect itself to kind of explain what really happens in a defense economy. Yeah. So firstly, see, this is an important table that you need to understand, that every year there will be some or the other, like typically if you look at 4 5 asset classes, one or two asset classes will really come up. I think a couple of months back in the webinar, I kind of explained the kind of asset classes that we all have to look at and the investment that we need to do. So I thought this time let me focus on showing you how the returns also work and why it is important to keep shifting your asset class as well. Okay, now if you look at, I think I'm showing what happened in calendar 2022 and 23, because there's a recency bias that you all have against investing, right? So you look at the returns. So US equity, which was the worst performer in 2022, became the best performer in 2023. And look at gold in 2021, who was the worst performer, became the best performer in 2022. So, but it is not like every time the worst performer in 1 year become the best performer the next year. You look at the last 2 years also, like real estate, for example, calendar 19, calendar 20, both there it was very poor performance. 21 also poor performance. It was just that gold did even better, poor. And then in 22, 23 is when you look, 22 and 24 probably is where you're actually seeing, okay, the prices have gone up and there is some kind of returns available. Also, please understand, when I say real estate, this is if you had invested money in land or buying an apartment or a flat or a bungalow or villa, what do you call it? Okay, if you have bought something like that, then you compare what is the yield that you're getting. So the rental yield that you get, or if it's not a rental property, say it's a self-occupied, like you are using the property for your residence, then what is the opportunity cost for you? So because you saved some money on rent, so that money plus the appreciation in the land value, these are the two primary factors, only factors rather, the only factors of real estate returns. Now, if you look at the real estate return, just look at the last 10 years table, it has never really crossed 10%. Occasionally, say in 2012, it had a very good year. In 11, 12 was a very good year, 9%, 10%. And then 2022, again, it was a very good year, 9%. But broadly, it is not something that, kind of consistently gives you returns. So in fact, last 2-3 months, I've heard from a lot of clients who are like, I want to withdraw some money because I want to buy some real estate, or some very good flat is available, or some very good plot is available at a very good deal. So even if you may think that it is a good deal, please understand, in real estate, what happens is the money is not made by an investor. The money is only made by the consumer. Okay, so you are buying a property for yourself. That case, you will make money because you are saving on the rental expense. And if you have bought a property today at a good location, gradually there will be some improvement in the real estate price, but that will be in line with what is the inflation. Okay, so what you used to pay for a basket of food 5 years ago versus what you pay for a basket of food today has gone up by 40-45%. Similarly, your real estate prices would have also gone by 40-45%. But then again, that will only be for land or a plot. When it comes to an apartment, think of it yourself. Would you want to buy a 5-year, 10-year-old flat today when the latest developers are bringing such a host of new amenities, automation, beautiful lighting, luxury, interiors, etc. You wouldn't have a preference for that. So even if the value of your plot may go up, the value of the flat which you own may actually be, relatively stable, or maybe slightly increase. It may not really go up. In fact, I have seen data points, like personally, anecdotal evidence. I have seen some cases where the flat value had actually gone down. Something that was worth 50 lakh rupees in 2013-14 is worth less than 50 lakhs today. The simple reason is nobody is interested to buy a 10-year-old flat, even if it is a very good location. They are like, you either give it for redevelopment, and when the redevelopment happens, maybe they'll make money. Okay, but till there's no redevelopment, you do not make money. And then again, within redevelopment also, there's a lot of issues. If it's an association, what does the association decide? You cannot yourself decide, okay, I want to redevelop my entire building. You only have rights over your flat. So these kind of issues come in real estate. Then gold, I'll cover in detail later also. Also wanted to show many people are nowadays having a fancy for US equity. So I mean, this table also corroborates the point that US equity is a very good performer. We usually recommend people to go for some mutual fund kind of investment in US equities. Primary reason being two. Number one, mutual funds can buy and sell equities without you generating any tax. Okay, so you have bought, say, 1 lakh worth of US equity, say 5 years ago. In the meantime, the fund may have bought so many times, they may have bought shares, so many times they've sold shares. But throughout the time, they will not have to pay any taxes. Only when you sell those units, that is when you have to pay tax. So that way, at a tax adjusted basis, you get very good returns when you invest in US equities via mutual funds. Other aspect why US equities as such is very interesting is because of tech. See, today, whatever we all use, I mean, I am using a Microsoft tablet, I use Microsoft Office, and you use an Apple phone or use Samsung phone. All these are running on hardware, software, technology. Everything is primarily US owned. I mean, companies in US, companies that are listed in US actually own it, and that is why the money that is made is also made in those stocks. Okay, in India, we are a more commoditized economy. We are an emerging market, right? So we are, we make money more on commodity type of products. Hardcore hardware, physical businesses is where we really make bulk of our money. The only place we have otherwise made money is the service industry that we all know. Infosys, TCS have been wealth creators for us, which in fact I would say they have created more wealth than US equities also over the last 20 years. So this aspect, I'm sure gives you some kind of understanding what asset allocation typically happens, and it is not important necessary that you always keep invested in a particular asset the most. Every year there will be some other asset which will actually be performing better. Our positioning should be like that the asset that has really performed very good in 2-3 years, we kind of lower our asset allocation there and probably increase our allocation in something which is not performing as well in the last 2-3 years, because it may have a better allocation in the next 1 or 2 years, better performance in the next 1 or 2 years, and hence increasing allocation in those asset classes will help you, generate an alpha, an extra return than what normally you could get. Now, coming specifically to Indian equities, in the longer run, compare it with whatever asset you want, Indian equities have outperformed everything. Just look at the number of times your money would have multiplied. Okay, if you are all of you know of the 72 rule and all that, right? So if you are holding a debt investment, a fixed income for 20 years, your money goes 7x. 1 lakh rupees after 20 years is worth 7 lakhs. But 1 lakh rupees in equity, just the Nifty 50 stocks itself would have been 16 lakhs. 19.6, 19 lakh rupees. That is the kind of returns that equities have generated. And in a longer term, you will realize that keeping your money safe is not important. I mean, it is important, but it is not as much important as the pace in which it is compounding. Okay, because look at yourselves today. Your needs have outgrown, right? You would have been happy 10 years ago with the 15,000 rupees phone. But today, your average buying price of a mobile phone is 50 to 70,000. So there is an inflation that kind of takes up. Now, investing in a fixed income, in a debt, or in a real estate will give you, a stable 7-8% kind of returns. But your expectations, your spending is growing at a much faster rate. So unless you invest a sizable allocation of assets, of your wealth into those assets that generate returns higher than the rate in which your expenses are growing. Okay, not just inflation. Please understand, inflation is only one aspect. The other aspect is development. Your lifestyle keeps improving. Okay, you may have been happy with a small car 5 years ago, 10 years ago, but today you may want a big car. Your family would have expanded, so you want 2 cars today. You may have one typical home, one residential home, and one you may have a holiday home. These kind of lifestyle expenses keep going up. Maybe 10 years ago you had one AC in your entire home. Today you may have 3 ACs in your 3-bedroom apartment. You may have had only one cot, bed, and whereas others are just lying beds. But today you may want cots in all your rooms. Okay, these kind of expenses have grown, and hence it is very critical that, as I said, keep having a proper asset allocation. Invest in those right assets so that both things happen. Your money is also protected, but your purchasing power, your power to keep spending also keep increasing. If you only invest in real estate or debt today, if you only do gold, real estate, debt also, I'm telling you this, only these 3 assets, if you put all your money in and you wait for 10 years, 10 years later, you will realize that you want to spend for something, but you don't have money. Okay, this is a very important aspect that you will realize later. My job today is try to educate you, and so that you understand this today itself, and you do not go in a situation 10 years later where you repent, I should have done some better investing decisions. Now, so this was one aspect. Now the other aspect is, crash in the market. This is again a very, very critical thing. So as I said yesterday also, I keep getting calls and messages ki Himanshu, prices have really gone up. It is time for us to book, wait for the market to correct, and then we'll re-enter. Many different stocks, many when our whole portfolio stocks are up to 50%, 300% in less than 6 months, 1 year. Why should we exit only 50%? Because I have been giving 50%. So they are like, nahi, let's exit entire 100%. In fact, some of you have actually done that. Your RMs have rather called you and at least or informed me, and I have then reached out to you to say, please don't do that. Unless you are really active investor, I would strongly recommend that you have paid money to us. Let us take the decision of what to invest and how much to exit. If you keep following, you will have less stress on your mind. You do not have the FOMO as well, the fear of missing out, and you will not have a repent also. So you will not have a I have seen people repenting actually because they exited some stocks. I'll give you an example of Ashiana Housing. So I have seen, because we track all of your portfolios, so I have seen portfolios where when we bought at 230, 240, Immediately next month, the results are very good. Some of the investors exited completely at 300. Okay. Next week itself, we told them, ki, okay, now it's back. It's around 300 only. Please buy it back. Just keep holding. But they didn't buy. Then the stock went to 360, and then they were calling us, ki, yeah, the stock has gone up. I should have bought. Shall I buy now? Shall I buy now? And we are like, no, don't buy now. I mean, our target was 360. It has hit 360. I don't make it doesn't make sense to immediately buy. In fact, when we revise targets also, so that time we revised the target to 360 to 410. That time it's also 360 to 410 is not a very big material jump for which I would recommend a buy. Like I've already always told you, I would typically look at return expectations. You are buying a short-term idea, you are looking at 30% returns annual basis. You are buying a long-term idea, safe idea, you are looking at 12 to 15 or 15 to 18% returns on a long-term basis. So that annualized return has to be there. There are hundreds of stocks which will, give some good movement in the next 5, 10, days or months, or something is happening with budget, and for the next 5 days the stock will go up. Should I buy? Election results came up, the stock corrected. Next day the market goes up, so I can make some quick returns. This is a very different mindset than an investor mindset. That is called a trading mindset. Okay. The trading mindset, if you have, then you need to be really active in the market. I work with some of the investors who are in a large corpus. They have a trading mindset, but then they have a very clear, philosophy that this much amount I will keep it as my long term, and this much amount I will keep as my short term. And when I do a short term, I mean not the SafeGainz long term, short term, rather their own trading. Okay, one is investing, one is trading. So the trading pool that they have, they keep buying and selling in that. I have seen in their portfolio sometimes they incur loss also, but they are fine with it, so they should do it. When they make profit, they call and tell me, see Himanshu, I made profit this much. But when they make loss, nobody informs me that they made a loss. However, please remember, with M Profit, I am looking at your portfolios, both the plus, the losses and the gains that you're making, and I have a very broad picture. Okay, what are you up to? And my only suggestion to you is, all the other investors is, these guys who can trade, only when they make profit, they will come to you and tell you they made profit. When they make a loss, they will not come to you to make a loss. Rather, they'll make a loss, it will come back to cost after so many days. Rather, it's about to go up. Okay, that time they'll exit it. I will tell you this case with PVR. It has happened. Like the client called me the day in May month, when we gave PVR call. He said, "Yeah, I just exited PVR few days back, and now you're again giving PVR." I'm like, "Why did you exit? We didn't ask you to exit." You understand the philosophy? He was like, he has been holding it for 6 years. The stock was back at his cost, and he was like, I can't see loss in that stock. So he just exited it. And we bought it at then, and you look at it now, it's up 20%. So it is very, very critical to understand what is your core, lifestyle, what is your core purpose. Do you want to be a trader in the stock market, or you want to be an investor? You want to be actively involved, like doing day trading and every day looking at what is happening with your portfolio, or you want to be laid back, you hired Himanshu, SafeGainz is that, SafeGainz will take care of your portfolio. Okay, these aspects you need to have it very clear in mind. Lot of distractions will come in this. I mean, when I say this, it may be easy for you to accept it immediately, but I know it very well that there will be a lot of distractions. Your friends, family, society, Twitter, Instagram influencers, everybody can come and tell you, I have done this, I have done that, this is how I made return. Today I bought an option for 5 rupees, it became 100 rupees by the end of the day. And you will also feel, okay, let me also try, then you will burn money. These are all cycles which we have gone through, and I have tried my best to educate you over the years. Strongly, I feel if anybody comes to you, you feel that FOMO in your hand, feel free to call us out. Myself, your RMs, just reach out to them. We can talk good sense into you. We can stop you from taking costly decisions. Many of you have this inhibitance ki Himanshu has told me, but still it seems very good. Let me try it once. Last week itself, we got one of our clients. He's been with us for 4 years. 3-4 months back, a broker reached out to him and he was like, see you, I'll give you trade ideas, sir. And he was initially making money. He made some 30,000-40,000 rupees on a 2 lakh investment, and he was really happy. And then suddenly he lost his entire capital in a span of 2 weeks. And then he came to me, Himanshu, see, I tried this, I made, but then I lost everything. Now you help me recover it. See, don't have that kind of mindset that because I gambled and I lost, I want to gamble again and earn it back. It is not possible. If you have that revenge kind of mindset, you will not make money. Okay, it is very, very critical that you have a very, kind of stable thinking. Okay, this was my learning cost, I have lost it, no problem, let me get back on the right track. It is like you're going on this track, okay, then you took a deviation, but that is a dead end. You lost the money, it's a dead end, you're gone. So best situation is not to, from here come back to this road. That is that half the time there will not be such kind of route. You have to come back to point A, which is your starting point, and resume on your journey again. Only then you can have a happy investing life. Okay. Now coming back to this slide. So like you can see here, the red bars, right? Every year there are phases in the market when the market crashes. Maybe it doesn't crash like in a week or something. It can be over a 3-month or a 2-month period as well, where it's like market is going like this, like this, like this, little bit up, little bit up, going down overall. So that kind of phase could also happen. And this is the kind of return, minus 10% on average is happening in every third year. You just look at it, out of 44 years data that I'm showing you, 35 years, there was a situation that the market was down more than 10%, and yet the return for the full year was positive. Okay, now one caveat here, these are all the large 50 stocks. These are not the 100 or 500 stocks that people typically look at today. So obviously that's a caveat. But I would say, I will come in the later chart also, but that overall, on a constructed basis, you will realize that those, after the 50 or after the 100, those 300, 400, 450 stocks have delivered higher returns. And obviously the risk is also higher, the drawdown is also higher, but the returns are also higher. And it is worth those returns for the time that you're spending with me. Okay, you are giving me fees, right? So for that fees, when you're able to get that higher returns, it is worth it. Understood? So just look at this average, look at the drawdown average, look at the upside average, 20% both the sides. However, between 1980 to 2024, the Sensex is from 4,000 to 80,000. It's a 20x in 44 years. That is the kind of money the top 30 stocks in India have been able to return. Understood? See, this is the chart on. So when I was showing you the the last chart, I was showing you the drawdowns. So now you are seeing 3 bars for each year, right? The gray bar, the light gray bar, that is the Sensex, and the dark red bar is your small cap 100 stocks. So what is small cap 100? Top 50, next 100, and then the next 100. So 50, 100, 100. So 150 first to 250 stocks in India. These are the stocks that are there in this chart, which is showing like the kind of fall that they have. So I think 4 months back, I recollect it to be the April month, maybe not the March. I had shown you a drawdown. Every few years, there is a big drawdown that happens in the market. Now you look at the same thing here also, you can see, right? So every year, only thing is there is a drawdown, but then there's an up correction also, uptrend also. Okay, and hence this chart will look different than that chart. I don't think I have that chart with me right now, but maybe you can see in my earlier video that typically when market corrects, overall small caps are the hardest to correct, and those aspects are there. And this is what even this chart is presenting. All we are saying is we have to live with the volatility. The volatility is the one that helps us make higher returns. See, if like say you are in the steel industry, okay, there is a Tata Steel, there's a Shyam Metallic, okay, and then there are some small steel companies. Okay, so Shyam Metallic is a mid-sized steel company. Tata Steel is the India's behemoth. Tata Steel owns the entire value chain of steel. Okay, right from the coal mining to the end products, everything they have in their own umbrella, and they are the least impacted in case of a cycle turn. Okay, they are also impacted, but they are least among the 3 impacted. A Shyam Metallics is a mid-scale company. Okay, they are having more capacity. They are sometimes they do job work for for Tata Steel, and they also have their own brand. And sometimes they give some job work to these smaller companies. Hence, what happens is they are somewhat better protected versus a very small company, because they is still higher in the value chain. This smallest companies, okay, these companies say suddenly steel prices corrects by 10 rupees. They cannot reduce their operating cost immediately. So what happens is they might be buying the raw materials for 35 rupees. They have to sell it for 40 rupees only, 5 rupees. So sometimes they get out of the business also. I mean, they are thrown out of the business. They've gone bankrupt. So many companies that you're seeing, Tata Steel has acquired 8 companies in the last 3 years. JSW Steel has acquired 4 companies in the last 3 years. All these people have acquired companies from bankruptcy. These are small companies that got bankrupted. So these situations, this is why the drawdown is. So what happens in a business reflects in the stock market as well. Okay, let's move to the next one. Guys, somewhere if I'm fast or something, please feel free to put your questions already. I've tried to keep 15-20 minutes at the end for questions, but if there's something pressing, I'll immediately take it as well. Just go through these charts and look at the number of days market corrects and the number of days the market takes to come back to the peak. So I think you can see my screen. I mean, you can see my cursor also. So 86 to 88, 700 days of what do you call bear market, in which there's 41% correction. So here it's written, time taken for fall, 1 year, 10 months, and time taken for recovery, 6 months. So it doesn't mean that there is a correlation how much time taken to fall, how much time taken to recover. But all I'm saying is there are phases of fall, there are phases of recovery. All these are like cycles. You can look, if you look at the total fall and recovery total in the years, you will find 3 years broadly, 2 to 3 years, or maybe sometimes goes to 4 years also. But this is broadly how the cycle has been. We have been in an uptrend since 2022, or maybe you can say, some people say April 2023, some people say November 2022. You can take whichever number, but broadly we have been in that uptrend for I think 15 to 18 months. Going ahead, I am not sure when the trough will, when the peak will come and when market starts correcting. But all I do is be aware that these are all cycles in the market. Currently, the cycles are good. In fact, I'll cover some companies also later where we kept holding the stock even though the target is done. Keep looking, using a mix of recent news, momentum factors, as well as technical again, to ensure that we try to capture maximum of the upside. Got it? Yeah, this again had to be covered today. There is never a reason not to buy equities. You look at all these, I mean, the upper left, right side will be more interesting, where, whenever there was people talking about some crisis is there, something or the other is there, then the stock still market comes back up. It may take a few months, it may take even a year for the market to come back up, but market has always been able to cross the previous highs and further deliver. Asset side, equity, I mean, debt investments go like this. Okay, it's a straight line. Your fixed return is there, and this is how, like, your money, if you keep compounding your money, your net worth will go like this. In equity, it is not like this. It is up, down, down, then full big up, then maybe little down, then maybe little big up, then again down, 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 maybe a sharp down, and then maybe coming back up. So this kind of chart is what you will see in equities. However, if you look at the time frame, this time frame of 10 years, fixed income would have gone like this, equity will go like this. Like, I mean, over from point here, it will come to point here. This big difference will be there. It is looking small in a 10-year, but when you make it 30 years, it will be here and here. This huge kind of differences will come. Like I showed you in the table earlier, equity, fixed income investment over a 20-year period was 4x. Over a 20-year period, equity money was 18x, 19x. Okay. Many of you have also come and told me, I bought some real estate 10 years ago. Today their value is up 3x. Right. But please understand, if you had invested in equity 10 years ago, your value would have been more than 10x. More than 10x. So 1 lakh is not 3 lakhs, 1 lakh is not 10 lakhs, it is more than 10 lakhs. So the 3 to 10, that huge difference you'll make out if you do not keep money invested in equities. Disclaimer, many of the slides that I've taken today, recently Funds India did a very good presentation and I was lucky to attend that, and I got my material from them to kind of help you all also to drive the message. Okay. Next part, gold. A big proponent of gold. I come from a Marwadi family. We hoard gold. Okay. No shame in accepting that. But please understand, our hoarding of gold is to protect ourselves. It is a protection for inflation. Gold is something that will protect you from rise in prices. Nothing else. You should not think that I bought gold. Like you can see in this chart, there are phases that will come where gold will not move for X number of years. You shouldn't say that I bought gold 3 years back and today my gold price is up 2x and hence it is equal to what equities are generated. You should rather look at a holding period. In the 3 years, if your gold price has gone up, your inflation would have also gone up. Gold beats inflation in the longer term, but it is just a protection against inflation. Okay. In the late 90s, the cost of bread was 5 rupees a loaf. Today, a 600 gram of bread, which is maida bread, costs 55 rupees. Okay, so from 1995 to 2024, in 30 years, your bread loaf has gone from 5 to 55, 11x. Right? And look at your gold price. Okay, gold has also gone up 11x only. You can see the chart here. In 1995, it was around 400 something. Today it is around 2004, not even 11x. In fact, it's much lesser than that. This is the kind of returns that gold will generate. Obviously, I mean, bread is not an anecdotal example, obviously, that it has actually gone up further because of whatever XYZ reasons. And today it's a more staple. So people are fine with paying a higher premium for bread versus maybe they'll pay for milk prices. But the broader aspect is that it can only protect your inflation. If you have need for gold, like we have traditional needs for gold, we have cultural needs for gold. Okay, that is a worthy investment. That is not an investment. I would say that is a spend. So what you would spend 5 years later on your kid's wedding, or you may have to, buy something or give something as a settlement or whatever. Gold is buying today. Gold is for that purpose only. You are just earmarking your future spend. You are locking the price that you will have to spend. Should something happen to the gold price because of inflation or because of turbulence in the global market, this is a good protection. Okay. And it is not that gold is just, kind of protecting. This is the chart that shows many years gold crashes as well. It doesn't crash as much as equity like we saw in the earlier chart, where 15% was kind of the average norm. Here, maybe 10 to 15% is the norm. Occasionally, some years there's a big drawdown, but there are, 2 months, 3 months, even 7, 8 months phases in the market where gold is a declining trend. So you may think that you need cash and you would want to sell gold, but at that time, it may not be that gold is available at an appropriate value worth selling at. It may so happen that gold was available at 75,000 in April 2024, but when you want to sell it in say Jan 2025, you may find gold at 68,000. A 10% correction is normal. So please understand what allocation that you need to do. Each of our clients, whenever we do your annual review, we spend time on this aspect as well, telling you, understanding what is your wealth allocation today, how it can be improved, what you need to improve, or sometimes it may be that you don't need to improve, rather you need to kind of get into safer investments. So that we do at a personal level. But I wanted to today specifically talk about these aspects so that you can be able to appreciate why we are pushing you to understand these aspects, why it is very critical to have an asset allocation framework, a formula in mind. This much percentage of assets have to be in gold, have to be in real estate, have to be in mutual funds, have to be in direct equities, maybe US equities, maybe some other alternate investments. You can have, as I said, 10, 15 buckets of investment, but you need to look at individual pieces as well as the entire basket. Like we say thali, right? So thali mein 4 varieties ki sabji, 2 varieties ki dal, two, three varieties ki roti, ek dal, rice, pulao, raita, everything has to be there. And everything has to be in appropriate quantity. You cannot have too much of rice or too much of very less amount of sabji, right? You have to have a decent balance. So that balance is subjected to everybody. A South Indian guy would want to have more amount of rice, a North Indian guy would want to have more amount of chapati. So everything has to be at your customized level. That is why we focus on boutique advisory, customized style of investing, asset allocation frameworks. Now, one more aspect of mutual funds that I wanted to cover, and I have seen this being very, very dominant aspect. If you are searching for a mutual fund today, like say you go to a Zerodha, you go to Paytm Money, you go to Grow, ET Money, any platform that you take up, you will find different ranks in different platform. Okay, I think do I have one more? You will find, say, a PPFAS or a quant fund in the top, like number 1 rank on one platform, but on another platform, it will be at number 3 rank. The same fund, the same risk category. Okay. They are doing bias. Why they do bias? They get money. Please understand this part. If you are getting something for free, you are the product. If you are getting something for free, somebody else is making money off you. If you are going to ET Money, you are going to Paytm, you are going to Grow and buying something and you're not paying them a commission. The reason is because he is getting commission from the AMC. He is getting commission from Quant, from PPFAS, from Nippon, from Aditya Birla, UTI, Bandhan, any fund house. Everybody pays money to these people so that their ranking is boosted. This is called advertising expense. And your SIP, from your SIP, they deduct 2%, 3% management fees, charges fees. And from that only they do this. So you are being taken for a ride. Okay. Hence, look at, completely independent websites or look at, paid advisors, because they will have, they may not have your best interest in hand, but I suspect if you know somebody, you trust somebody, he will have your best interest in mind. Today, you trust me with your equity investing decisions because I have your best interest in mind. I know your portfolio, I know your investing habits, I know your investing decisions and your portfolio return expectations. And accordingly, I come up with buy sell recommendations for you. Similarly, a mutual fund advisor, even you could come to us also, you could go to somebody else also, it's up to you. We will have your best interest in mind when recommending a particular fund or a particular AMC to you. I have already given examples of, fund managers changing, and because of fund managers, people are not able to make money. The good fund manager goes to some other fund, or he quits India, or he gets into PMS, he leaves fund management. And then maybe that same fund will not have very good returns. This could happen. Okay. And the second aspect, the fund that was, you look at this chart, let's look at the current table, 2021 to 2023. Okay. You are seeing the first ranked fund today was ranked 160 for its 2018 to 2020 performance. So for 3 years, 2018, 19, 20, it was ranked 160 out of 500 funds. Today it is ranked number 1. So what was a poor performer back then is a good performer today. So if you are buying something today, it may not be necessary that he is the best performer next 5 years also. What I have shown here. Okay. See, 2014 fund B rank is 1. 2015 it is 108. 2016 it is 124. 17 again it is rank 1. Okay. Now this happens because there's a particular investing philosophy. So you know about SafeGainz investing philosophy and you will be able to benchmark my returns. But when you benchmark some A to J 10 funds, each of them may have different investing philosophies. One could be a value fund, one could be a growth fund, one could be a momentum fund, one could be a large cap fund, one could be a small cap fund. Okay, so everybody will have their own, periods when they will be the best. It is critical for you to, as I said, have a basket. So similarly, the thali you may have maybe a separate thali for mutual funds, like a thali inside the thali for mutual funds, where you have a basket of funds. In fact, our clients would know this very clearly, that whenever you ask us for fund ideas, we have tried to give you a basket, one value fund, one large cap fund, small cap we anyway take care for you. So we don't give you small cap fund. Maybe if some theme is going on, say China was going on recently, or earlier some theme was going on tech industry or on US industry. So we might tell you, okay, for the next 1 year only, start doing SIP in this much amount. So those kind of tactical calls we can take for you, because we are taking an informed decision for you. Now, when you are taking informed decision yourself, you need to also take into account all these factors, all these variables, and why one rank could be different than another, and why one should be better today. As a thumb of rule, I always tell people, don't invest in the top 2 performing funds in a year. Look at the 3-year performance of every fund. The ones who have done very good for the last 2 years, don't invest in them. Just look at this chart again. You can go through any time period. Look at the rank where they were and where they are in the next 3. It is never, not even one case where there is like for the next 3, 6, 9 year period, it is consistently done. Like you can see here, there is this 13 to 15 and 16 to 18. There's one guy. Okay, he was rank 1, then he was rank 2, and then he earlier also 4 and 2. I'll tell you which fund this is. This is HDFC Top 100. Okay, so they were doing in their category. They were doing very well for this period, and then they kind of started losing steam. So these phases come in the market. These phases will impact your performance. Okay, so you need to have, you shouldn't invest in 10, 20 funds. You need to invest in only 3 to 4 funds. You need to have a sizable equity corpus, a sizable mutual fund corpus, reasonable amount of gold, real estate corpus. This is how asset allocation has to be done. Okay, I think I've already overshot my time. Let me quickly run through the defense part also. Guys, I know many of you have queries on Mazagon Dock, Cochin Shipyard, Garden Shipbuilders, Centrology. I think these 4 names came out to us. I have looked at Cochin Shipyard in detail. In fact, Cochin Shipyard was our bet. Back in 2021, we have bought it around 370, 400 levels, but we got it around 800, 900, and it is about 2000 plus today. But the reason why we don't want to kind of keep holding or give a fresh buy in these defense stocks, I have listed 5 points for you. Okay, one, obviously why we don't want to buy today is market cap is higher than order book. Now please understand, in this order book, if a company has a 40,000 crore order book today, he is not going to execute it next year, and he's not going to make 20% profit out of it. So it is not like he's going to have 8,000 crore profit. And say if you want to pay a PE multiple of 15x, it is not like you should pay 1.2 lakh crore for that. It is not the case. The case is, this order book, they are supposed to execute in 5 to 7 years. However, it has been the history of India, and it's not just India, it's globally this thing happens. Okay, please understand this. This is not an India phenomenon, it is a global phenomenon. Projects get delayed. A national highway has to be built, a bridge has to be built, land has to be acquired. For somebody owns that land, he may have a farm at that land, he may have some home at that land, he may not be interested to sell immediately. There could be regulatory issues, there could be environmental issues, there could be issues on supplier side. X number of reasons are there. Historically, these defense projects have taken 10 years to 12 years for execution. Okay, what you are seeing in the last 2-3 years, these projects are supposed to be delivered in 2017. Please understand, these projects, the ships that are being delivered in 2022 and 2023, were supposed to have been delivered in 2017, 2018. What happened then? Commodity inflation happened. Government, wanted to do things, but a lot of places, because of RE, RA and those things, regulatory changes are happening. They were not able to acquire the land, and hence the cost kept going up. So what happened is, like I was looking at Mazagon Dock, until September 2022, they never made more than 7% margins. Forget, I have written 10%, they didn't make more than 7% only. It is just the last 6 quarters they have been able to make 10% EBITDA margins. Reason, the prices were done then, there has been a correction in the cost, the commodity costs, and hence they have been able to make money. Now, here one important aspect comes in. See, who is the buyer here? Government is the buyer. Who is the seller? PSU, government company. 75% with government, 85-90% with the government. So from one hand, government is taking, the other hand, government is giving money. Right. Now, please understand, why will government give money from here to here? Whenever government gives more money from here to here, it leads to inflation. In RBI, government, everybody wants to control inflation. So what they will do is something worth 100 rupees, because here there is private capital also. So this is Mazagon Dock. Okay, this is Mazagon and this is government. Now Mazagon Dock has some percentage of capital, private money. So what they do, the manufacturing cost is 100 rupees. This is government. Government owns 85%. What Mazagon will do, they will give it 110 rupees to government and get 110 rupees from the government. 10 rupees profit. Out of 10 rupees, 8 rupees comes back to government. Got it? So 102 is the cost. Something worth 100 rupees, government paying 102 rupees, private takes 2 rupees. This is the inflation aspect. Now, people are thinking government will, this company, Mazagon Dock, will make 15% margin. How is that possible? Then what will happen? 100 rupees, sell for 115. Out of 115, only 80%. So that instead of getting 2 rupees, this private investor in this company will get 4 rupees. Government will not allow that. That is the reason many of the disinvestment has not happened. Petrol prices are supposed to go up. Okay. Initially, government wanted to sell a company called BPCL. They were not able to sell. Okay. Then, when petrol prices were about to come up, lot of private investors showed interest to government. We will buy BPCL. Government said no. Government will never make private people make money in government business. Okay. So when you understand this aspect, you will realize in a longer term, it is not worth investing. In the short term, we will also invest. When we find valuations are right, when we find, maybe in some stocks, you can say that we missed the bus, but we are not sad because of that, because we bought some very good other stocks where we had more conviction, where we were confident of making 100% and ended up making 250%. Okay. So it is not that only with those, had I invested only in Cochin and Garden Reach and Zen or Mazagon, only I had made a very good portfolio. I didn't invest in any of these 4 stocks, and yet my portfolio is as good as the other portfolio. You are understanding the aspect, because you can't have a defense-only portfolio, right? You would have invested in 20 other stocks. So overall, your portfolio would have been like that, like how it is ours. So when you understand this aspect, then you will realize it is not worth chasing any stock idea. It is not worth chasing a particular stock which is in momentum. Quick update on DCX. This is the only defense company that we are currently holding. We like DCS. We have recently done profit booking, so disclosure for that as well for any of the investors who are not client of ours. But we will continue to remain invested. These are the 4 reasons. I have already spoken a lot on DCX, so I will not repeat my points. But all I will say is, with the kind of things that are happening at Israel, with the kind of partnerships DCX is building, number 1, Israel. Number 2, US. US has a defense company called Lockheed Martin. Number 3, in India, L&T. These 3 are going to the largest defense companies in each of their countries. L&T is actually one of the largest players. Only thing is, they are not directly doing it. They do everything as subcontract. But now when government is giving PLI, they will also get into direct business. One more important aspect I just want to tell you, like some of you are, ethically you may feel that I should be investing in defense. So I am also Jain Marwadi. I typically don't go on stocks that really promote, war or promote thin goods. If you see, I have never promoted any of these, meat stocks or frozen food stocks, the fish meat companies and all. However, this DCX, why I like it again is they focus on defense. So they have missile alarm system, missile protectors. Okay, so they have machines which can radar machines. So earlier also defense, I'll tell you some names that we have done earlier. One is Astra Microwave, other is Dynamatic Technologies. In fact, Dynamatic is part of our old portfolio still. These are companies which are focusing on protectional weapons, not on attacking, because that is what I feel like. So if you are also thinking, of the mindset, be very sure. Typically, I will not give any that kind of stock which actually promotes warfare. Companies that actually create weapons, I would not want to invest in those kind of companies. And if you have any specific, any other, cultural or traditional, sectors or companies or businesses that you would want to avoid, people already have told us, and you can also, if you're not yet told us, you can come to us and put it in the message group in your group that these kind of stocks I would not like to invest in. We will keep that in mind when we're recommending stock ideas to you. Okay, I think this part again I've already covered that we are very focused on how to play the theme. Same with the defense. When the companies will be good, we will do that. Yeah, ITD and Amar Raja. So ITD, we did this partial exit. So I'll tell you something what happened with ITD. Is there a chart? Okay, we don't have the ITD chart. Sorry. So ITD, let me see if I can. So ITD Cementation has had a fantastic time since we bought it. Any of you can go through the chart on your personal devices as well. We bought this stock when it was very attractive valuation around 160 odd. This was not a typical play that we do wherein we look at companies that are in the downtrend. Rather, we bought it somewhere here. Okay, around July, this period, because we felt some very strong tailwinds coming up, which gave us clarity that okay, this company can do good. Typically, we buy stocks which are in the downtrend, wherein our money kind of stays protected. But here, the kind of industry tailwind was so strong that we bought these companies. And initial target was I think 240. Then we which came in like 3 months. Then we revised it to 320. It went to 350. It came back down, and we were like, okay, if it comes to 320 again, let's invest. But by that time, earnings season was there. It reported very strong results. We had full confidence that it should hit 440. It went to 440. At 440 that very day, the reason it crossed 440 was because they were announcing very good orders that they've got. Some 3 Jal Jeevan related projects that they got, and these are executed in less than 1 year. So imagine, I mean, you are here one side looking at defense companies, 10-year project, 7-year project, and here you have a company which is going to immediately generate 1,000 crore revenue in 1 year because the project is in hand and delivery time is 12 months. So that kind of visibility supported us to keep remaining invested here. Recently, we have done profit booking. Only reason was management, the promoter, look at the promoter, Indo-Thai, these guys decided they already own a small stake only. Okay, 46%. It's a Thai company. It's a very, very popular Thai company. They are also big in construction there as well. In fact, they have presence in UK as well. This Italian Thai company decided that okay, the share price is really gone up, so they wanted to sell something. I am not sure when they'll sell, how much they'll sell, but that very day when we got the information that they were looking to sell, we did some profit booking. The rest of the shares, let us remain invested. We are confident on the story that the company is going through. If we see that okay, the peak has been done or whatever, then we'll take another call. Okay. Amar Raja already shared a message in the group. Amar Raja is really done some very good things since we bought. Now more and more investors are looking at it. This Goshan is actually a pioneer in lithium iron phosphate. People also call it LFP batteries. What LFP can do is the range anxiety that we all have today, that 200, 300 kilometers maximum is what a car can do. If the kind of LFP batteries that Goshen is working on, they are promising 500 kilometers plus in one ride, in one charge. That kind of range that they're going to come up with. In fact, they are also promising on reduced charging time. Today, 7 to 8 hours has become the average for an Exxon EV. But what they are saying is maybe they could give you a quick, 4-hour charge. If you charge for just 3 or 4 hours, you'll be able to run for like 200 to 240 kilometers. So this kind of very good, data that they are, update that they are showing gives us confidence. Okay, let us, remain invested here. The stock has really rallied up. It has hit our targets of 1500. We have already interacted with the management once. We are waiting for this next month, this month results. Probably then we'll take a call and what could be the target of this company. I think the third pick is Suez Estate. The target has achieved. It was 500 rupees. The stock is trading at 600 plus. For now, let's keep invested. Like I wanted to show all these three for this very reason, that this is how markets are. Real estate, the way they are working today. It's a very, very good time to be invested in real estate. We bought Kolte Patil 2022, 2023. We sold Kolte Patil. We bought Ashiana. Ashiana was coming to our target. Before that, we bought Suraj. Ashiana hit our target. We have exited Ashiana. We continue to hold Suraj. So this kind of, in a particular theme also, we keep rotating or churning. You look at the price today, it is 412. You look at Kolte Patil. After we sold 480, it went to 540. But there again, promoter decided to sell. Stock crashed. Today it's back to 420. So this is what we are trying to do for you. When there's a theme, we are on top of it. We will try to identify those very, very critical themes where money is safe. You have seen real estate was not doing great, but then there was a short jump up in the plot prices, and hence all these companies are able to sell their old lands at much better realizations, and hence we continue to keep invested in them. Okay, that's it. I think I'm out of time as well. Let me quickly see. Yeah, guys, I just have another 1 minute to take. I have quite a few questions here. Okay. Yeah, retirement. Guys, as I said, asset allocation I explained to you. In fact, retirement is a very key aspect for that. We very carefully work. In fact, our clients, I think you're not a client with us, so you have this question, but our clients ask, inform us 5 years, 10 years, even 2 years in advance. Like one client joined with us 2 years back, and he told me, Himanshu, I will be retiring in 2024 October. Okay, please plan my portfolio accordingly. And he was short on returns. Let me tell you that also. He had just one stock in his portfolio, and that was of 25 lakhs. And he was short on that. Like the kind of things that he wanted to do post-retirement. He wanted to plan a consultancy. He wanted to buy a proper home at his hometown because he wanted to retire there. But for that, he didn't have money.
The webinar has ended. Thank you for joining. Goodbye.
Hey guys, I think I was hitting on Q&A, but I ended the call. But I think glad that at least a couple of you have already joined in. Just wait for 2 minutes. Others are also joining back. Okay, we are having a few guys in. I will share we'll anyway have the recording also uploaded for all the investors. So you can then look at it. Is the recording on? Okay, cool. So yeah, so coming to the question part, so I think many had this question on retirement. Please understand, it is very important to plan for retirement. Okay, when you're young, when you're in your 30s or the early 40s, it doesn't matter as much to think of it. But if you have a mindset of clarity, that I need to be invested and I need to just have, like what we do with our clients is we have a written, thing that we ask them to tell us what do they want to, at the age of 60, what would they want, or over the next 25 years, what is the timeline that they are looking at? When are they looking at the kids' education, higher education funds, or they have the plan to say exit, leave their current employment and start with a business venture or switch jobs because of this there will be some turbulence in the finances. So these kind of aspects we help you plan accordingly. Whenever you need money, we kind of plan it so that we have the exits at the right time. Your overall asset allocation also ensures that you're properly generating some liquid assets as well, which can generate returns and yet be liquid enough that when you need money, you have the money. It can't be that you have a big amount and then you will only need everything to withdraw at the same time. Then you wouldn't know what to do. So those aspects we cover that aspect. Like I said, people who join with us tell us in advance, that this is our retirement age. In fact, 2 months back, we have got a new client as well who is retiring in the month of January. 2 years back, we got a client who was told us 2 years back, see, October 2024, I will be retiring. So please plan my portfolio accordingly. So we take care of that specifically. The one who will be retiring in Jan, for example, she just joined us back last month. And again, in her case also, what we have found is the portfolio is right now not ready to kind of manage a retirement life. However, because she is working in a PSU, she is kind of protected with her, the huge retirement corpus that you typically get when you work for an government company. That will kind of help her give a buffer. But if she has, kind of extravagant plans, unfortunately, that can't be supported by her current savings. So this thing we will try to help you out on, if you give us that time and bandwidth. I've already told we do, income tax returns, we are not directly filing it for you. It is always, we recommend people to do their own income tax returns. What we do is, through our ERP, we share, proper data on what you need to file in your income tax return. Mutual funds we've already been providing to our clients. Any of you have mutual fund queries, you can always, reach out to us. In fact, we are planning to get a mutual fund registration as well, wherein we can also kind of sell mutual funds. But till date, we always avoid selling mutual funds. The simple reason being that there is a kind of independence that we are giving to you. So we are partnered with some guys, but we do not recommend them also. We just you do however you are. If you don't know anybody and you are looking for somebody to advise, then we are there for that. It is right time to start investing. Yeah, I've told you. There's never a wrong time to invest. There's never a right time to exit the market. Okay, never exit the market. Keep invested, keep booking profits, and keep holding to investments. Yes, so we have the question is on US equity. Should we bifurcate some of our portfolio there? Definitely it is worth, but there again, only in tech is what I would say the story is. So we look at NASDAQ funds, we look at specifically tech related fund of funds that are available within India. Last year, what happened was there was a shortage of investors. So what happened was government put a cap that you cannot invest more than this much amount as an India, as a country level. We cannot invest more than this much amount in a particular tech fund. And because of it, there was a shortage. Many of the funds stopped taking investment. That's why we also did not recommend to you specifically. We are expecting now that the election and everything is over, government will once again give some relaxation there. Once that is there, we will start investing again in US funds. Off lately, we have been suggesting some of the clients, again, strictly based on risk profile, if they should be investing in China as well. Because we feel there is protection of money in China, and there is a potential to make higher returns than India in a shorter term, not a long term. In the short term, in a 2-year, 3-year time frame, it is a very good possibility that China delivers higher returns than India. Okay, next question is IRFC splitting again. Yeah, IRFC is already trading at very expensive valuations. We already asked our investors to exit at around 160 odd levels. The ones who are holding, it is not a recent bet. We have bought it only after the IPO at around 40 rupees. It's already a 4x since that. Not worth investing currently. Doesn't matter from the tax angle also. I would just suggest book profits and kind of protect your capital. I'm not sure about steel companies merger, Praveen. I think the only aspect that anybody has to look at is all these companies have to be bought in the down cycle only. Right now is not an up cycle to be investing in steel. Yeah, so brokers being true to label, uh, frankly, it is anybody's guess what brokers do. All I can tell you is it's a very competitive market. I don't think they can immediately increase, brokerages. Many of you are using Angel and Zerodha and Upstocks, which are free delivery formats. I am not sure whether they can actually come back to the 10 rupee, 20 rupees model again, or maybe they will come to that 0.3% or 20 rupees, whichever is lower. It could be anything. But yeah, they were notorious. See, they have done. Zerodha is not a kind of company that has uh, not faced disruption. They have seen this. They were pioneered with this, but then over the years, many things happened. Many of the old age brokerages like ICC and Kotak also tried to convert their business model to match with Zerodha, but then they went back to their existing business model and they had their own client base. So I don't think it will impact anybody as much. It is specifically what really happening is very very under the table. The US investors or the brokers are not actually going to get impacted. What gets impacted is there's an inherent nexus. So there's the broker, and there's an influencer in the middle who is connecting many of these brokers to the customer. This influencer will get impacted. These are not guys who have your best interest in mind. They have their own commissions in their mind. This is all that they care about. They will have their free coupon codes and special reference codes to use. I would say that is the only relationship that's going to get impacted. For us, it's no impact. I am anyway SEBI registered advisor, so I have always been under SEBI purview. So which fund comparison tool or website we should refer for mutual fund? I usually compare 3-year, 5-year, 10-year, invest in top funds based on those returns. Is that enough, or is there any other parameter? Two important things to be looked at. Number one, before doing all this, like you will do this, you will come up with a list. It will give you top 5. Okay. Either all these 5 funds, you go to their website, read their investment philosophy, look at their cash allocation, look at their portfolio, how much are they investing, where are they investing, and how have they been able to generate the returns over a cycle. A cycle is typically 7 to 8 years. Okay, and then decide which one to invest. So first aspect, obviously we'll have to rank. I would say 3 years is very less, especially last year is very poor comparison. Go for 5 to 10 years. My personal preference would be 7 to 10 years. 7-year ILC, 10-year ILC. 7 years is one cycle, 10 years is one decade. Even if the fund manager has changed or whatever, a fund, how have they performed in 10 years is a good enough benchmark. And then the 5 names which will come, I will skip the first 2. The last 3, I will look at them in detail, understand what is the risk allocation and how have they generated the alpha, and then I invest. I will give you a very, very unpopular opinion today. You may not have heard this. We have also recommended people to invest in PPFAS funds. But recent study of PPFAS, like how have they generated returns? They have not generated returns by staying invested in Indian equities. They have generated returns by investing in US markets. They have very big portfolio in US, in Europe, in China. Okay. Until 2022, they were not invested in China. Only in 2023, they've started buying China. Chinese markets have gone up 30% in the last 1 year. And not 30, sorry, 18, 19%. And their portfolio from China, the Chinese stocks have gone 30% on average. This is why they have been able to make money. So understand who is doing what. That is one of the reasons we keep saying, okay, buy PPFAS, because via PPFAS, you are invested in not just US, you're invested in Europe and China as well, which gives you, kind of visibility to all these markets. And they have been smart in picking stocks. Only thing is not as smart in India as they have been outside. And hence, it is a good fund to be invested in. Okay, I think these are all the questions. Thank you for all the people who joined back. Really apologies that for the technical mistake. I will be sharing the YouTube link as well for you as well as for all the other investors with SafeGainz. Let's connect next month. Bye.